after a relatively gentle start to 2017, the news flow is going to start coming thick and fast. There's a good smattering of macro news on both sides of the pond, including UK industrial and manufacturing output figures on Wednesday the 11th of January. But the real focus is going to be the torrent of company news flow. 3 sectors in particular are going to be in focus. First, the house builders. Bovis has already let the side down with a profit warning just before New Year, so let's see what Taylor Wimpey say on the 11th, followed by Barrett on the 12th. Second, food retailers. We're due to get full year results from Morrison's on the 10th, and Christmas trading statements from Sainsbury's on the 11th and Tesco on the 12th. And finally, general retailers, with Majestic 1 on the 9th, and then on the 12th, we get trading updates from Primark owner AB Foods, ASOS, Burberry, Debenhams, Dunelm, and Supergroup. But for all of that lot, the festive season statement, which could really cause a fuss in the week ahead, is the third quarter update due from Marks & Spencer on Thursday the 12th of January. This is a big one for Chief Executive Steve Rowe, who took over last April, not least because the shares have fallen from north of £4 to around £3.50 since he took over, and during that time the FTSE 100 has added around 1,000 points. So it's fair to say that Rowe's reign is off to a slow start in share price terms. But he's been making major changes at the underperforming High Street bellwether behind the scenes. Overseas operations are being closed or rationalised, top-heavy management teams are being pruned back at headquarters, pricing points have been cut, clothing ranges overhauled and sub-brands de-emphasised. Now it's going to take time for these changes to come through, but the third quarter update will be a good test. Not least because the base for comparison is so easy. Last year Q3 was horrendous as UK total like-for-like sales fell 2.5%. Food rose 0.4% like-for-like, but the problem general merchandise arm fell 5.8%, and that was against a 5.8% drop the year before. Those numbers were so bad, boss Mark Bolland eventually fell on his sword shortly after. But the good news for Rowe is this does provide again an easy comp. Here's the trend in like-for-like sales growth year on year at the clothing and home operation, which is Rowe's real priority when it comes to fixing things. So, the key numbers to watch are the like-for-like sales trends at clothing and home, as already noted, which was down 2.9% in Q2, food, down 0.9% like-for-like in Q2, and M&S.com, which underperformed again with a meagre 0.4% sales increase in the second quarter. Also watch for any guidance on gross margin and progress reports on the withdrawal from 10 overseas markets, as well as the repositioning of floor space in the UK away from clothing and home, presumably toward food and also the ever popular cafes and coffee shops. Besides the soft base for comparison, Rowe's got one other thing on his side now: UK consumer confidence. This final chart shows the apparent link between the M&S share price and the GfK UK consumer confidence indicator. And the recent improvement in the macro stat offers some hope, as do better autumnal trading conditions, even if, as we know, the past is no guarantee for the future. Now, M&S is a stock that's disappointed for the thick end of a decade, so Rowe's task is a big one, but at least expectations are low as reflected by the valuation. M&S trades on PE discount of 12 times and offers a premium dividend yield of 5.4% relative to the FTSE 100. Even if dividend cover is skinnier than you would like at 1.5 times, this does suggest a lot of people have given up on the stock, so let's see if Rowe can succeed in his plan to restore the brand to national favour. Thank you for watching, and I look forward to seeing you next time.